In this video, what I want to do is talk to you about the purpose of bookkeeping for tax and financial accounting and try to work backwards, tell you what we're going to do, and then go to the end and show you why it's so relevant and really a rather straightforward process. So in the tax versus managerial accounting subdomain, we have an image here and it says bookkeeping for tax accounting, aka bookkeeping for financial accounting, is required by others. And the universal reporting goals are the income statement and the balance sheet. Now, the first question you should ask is, well, why do I care? Why is the income statement so important or so valuable? Well, first, let's look and see what the income statement looks like. The income statement is prepared for a date range. The date range could be a day, a week, a month, 13 days, 26 days, a quarter, a year. For tax purposes, it's typically a year. It has a start date, it has an end date. And what it lists is an aggregated number for income and returns. So income is money that flowed into your business. Let's use a small business as an example first. And then it has an aggregated information for expenses such as advertising, car and truck expenses, commissions and fees. Now, the names we've chosen for these accounts, these can be referred to as accounts or account name or chart of account or chartered accounting, but they also can be referred to as categories. These can be called anything you want. You don't have to call this '08 advertising. You could call it advertising, and you could call it advertising underscore print, and you could have another one, advertising underscore internet or digital, advertising underscore billboards. But let's just go with this for a second and see why we did this. This is an income statement. It breaks these down into subtotals, and the end goal is over here. We have income, expenses, a different kind of expenses leaves us with net income. This is also why we prefer to rename this statement as a net income statement, because that's really what you get out of this. You get net income is the value you're looking for. Why is that relevant? If you are a sole proprietor or an S corp, a sole proprietor or an LLC, or maybe a simple partnership, the form you're required to fill out for the IRS for your taxes is Schedule C. Schedule C at the top says it's a profit or loss from business. Well, if you recall, a profit or loss statement is the exact same thing as an income statement, which is the exact same thing as a net income statement. So the reason that this income statement is so important is that if you can prepare an income statement, you've done the work you need to do to file your taxes. On this Schedule C, the reporting is broken down to 3 areas. Part 1 is income, gross receipts or sales. That sounds familiar. Part 2 is expenses. And oh my, look at what we have. We have 8 advertising, 9 car and truck expenses, 10 commission and fees. Sounds just like what we've done in our worksheet. The third section over here on a Schedule C is cost of goods sold, also known as inventory. So if you're selling inventory. Now, the interesting thing about this is you don't have to have a digital inventory system to report inventory sales. The way this works is you report your inventory at the beginning of the year. You report your purchases of inventory, and then you report your inventory at the end of the year. If I had $1,200 in inventory on January 1st, and I purchased $500 worth of inventory during the year, and I had $1,200, magically happened to have exactly $1,200 of inventory at the end of the year, it means I sold $500 worth of inventory. No digital systems required, no automation required. So this top part 1 and part 2, actually comes directly from an income statement. Now, you could have named these anything you wanted, and that's what QuickBooks and many of the other software vendors encourage you to do. Oh, just name them this, and then you'll assign it the tax category later. We don't advocate that. We advocate that you actually use the tax categories for your account names for this simple bookkeeping template. This dramatically simplifies the process. If you want to create an income statement with a different, much more granular set of categories, what we encourage you to do is simply set up 2 files. This isn't cheating. One's not a valid or invalid file. In theory, they both should come out with the same information, but there is an advantage to doing the two files separately, and I'll get into that when we get into the balance sheet. So the simplest way to do bookkeeping for tax accounting is, in fact, with this very simple bookkeeping template with a chart of accounts that has income and expenses that aligns directly with the tax form that you need to fill out. And then we will explain exactly how you do this inventory tracking or inventory adjustment with a cost of goods sold category in here in another video. But this is why. So then we get to the process. How does this work? So here we are. We have an income statement. Let's get back to our income statement here. Where does this information come from? This information comes from your journals, from your credit card journal and your checking journal. Literally, it's just a list of transactions. On 1/4, there were monthly fees for business for -$16. This is a checking account, so it decreased my account. And we assigned a category commission and fees. So if I came over here and looked at commission and fees, of that $128, 16 of them comes from this line item. It's that simple. Now, and the checking transactions and the credit card transactions are all blended together to create this report. Now, the next question is where did these transactions come from? They can come from three places. The first is a shoebox. The second is your paper bank statement. You could take the paper bank statement and copy them and transcribe them in. And the third, which is what we advocate, is you log into your bank and you download the transactions in a comma separated value format or an Excel format or some other kind of delimited format that they offer. And then you use a simple process where you paste that information into a raw transactions worksheet for long-term storage. Then we map the fields that we want, the columns that we want, into a format that we want, and you paste those in here. So we've just tracked the process. Our end goal is a profit and loss statement for the federal government, and the starting point is the transactions as they showed up in our bank account. Now, if we go to this 6-box model that we have, which we use both for education and to organize the software, what we're really talking about is this module right here, this template right here. And ours is a double entry bookkeeping template. And what we're really talking about is getting to the point to where we talk about the payment inflows and payment outflows, which are the inflows and outflows to the bank. So this doesn't start with a sales system. It doesn't start with advanced accounting systems. This process actually starts from your payment inflows to the bank, because once the information shows up in the bank, it then shows up in the bookkeeping system. So imagine there's almost a little imaginary dividing line here that can separate these two when we do bookkeeping for tax accounting. It starts here, our template starts here, but the information that we use that gets fed in here starts with the deposit to the bank or withdrawal from the bank. That's it. So hope this helps out for the information regarding the purpose and process of bookkeeping. But before we check out, there's one more thing that we want to talk about briefly, or just at least introduce. So now that we know what the income statement is, the next question you're going to have is, which you should have, is, well, what's the balance sheet then? So I understand what the income statement is. It seems like it does everything I need for taxes. The balance sheet is a cross-check mechanism. It's really a reconciliation mechanism. It's not while part of it is a snapshot in time as advertised, what it really does is it offers a unique way to attempt to cross-check the information that you actually use to create your income statement to help ensure there were no egregious errors or omissions. It doesn't mean that you couldn't cheat. It doesn't mean that things weren't wrong, but it gives a decent idea that there were no transactions that were completely omitted from the process, and there were no really egregious categorization mistakes made, such as in the checking journal, you actually assign the account to itself or the transaction to itself as opposed to another asset, liability, income or expense category. So we'll go over that balance sheet in the next video or in another video. But this is why this is a very simple process. It's a very straightforward process. And this is why you do not want to mix tax accounting with managerial accounting. Again, you could create an income statement or a chart of accounts with different categories that is much more friendly for managerial accounting with a lot more resolution, a lot more details. But you don't want to do that for several reasons. And if you really want an income statement for that, or an income statement for budgeting that uses your own accounts, just set up a separate file. We'll explain this a little bit more later, but hopefully this gets you generally oriented to the purpose and process of bookkeeping as we define it.